HTJ.tax, the international tax firm for 6, 7, and 8-figure investors and entrepreneurs who are living that international life. Are you ready?
I have a question about CGT, capital gains taxes. If you sell an investment property in Australia, I understand that it will be liable for capital gains tax in the US. However, will capital gains tax paid in Australia be offset against any amount owing to the US? And the answer to that is usually yes. The US does recognize foreign tax credits, so that's a possibility. Yeah. The second part of her question: will the tax breaks available for me in Australia for this? In brackets, she has a principal residence exemption, the 50% reduction for owning the property for a long time. That's close quote. Will that carry over to the US, or will they calculate it in their own way regardless? Now, to answer that, there is a principal residence exclusion, assuming that you resided in it for 2 of the most recent 5 years. You will get an exemption on any the capital gains tax liability to the US. It's $250 if you're single and $500,000 US if you are filing jointly. So it's not exactly as Australia does it, but there is a recognition that, hey, this was not really an investment property, at least not 100%. I lived in it. It was my primary residence. So you do get a tax break in some way. So,
yes. Yeah. I've dealt with this in the past in terms of where we have a property that was your main residence, but over the total ownership period, it was also an investment property. Then we have an absence, what they call an absence rule, where if you rent it, if you live there, then you moved out, you can rent it for up to 6 years. And then when you sell it, it's still completely tax-free. If you rented it out for 10 years, then the 4 years after the end of the 6-year absence rule, there would be a pro rata kind of calculation. The taxable portion is taxed in the usual way. You'd get the 50% discount, all of those things. And the exempt component is 100% exempt. So you can be in a situation where if you just purchased a property, you live there, you had this huge capital gain, which is completely tax-free in Australia. It might still be assessable in the US because they have caps. That's one of the few circumstances where America doesn't have a kind of more taxpayer-friendly kind of outcome than Australia, because we have an uncapped main residence exemption, whereas from their perspective, it's capped at mentioned the 250 or the 500. But that's the US, so you also have to do the exchange.
Exactly. Thanks a lot for that. And the final part of Maggie's 3-part question is there a formula to calculate what my potential liability might be in the US? Yes, there is, but it's probably a bit too involved to just explain for you to replicate it. But essentially, you take what the sales proceeds would be and you deduct the selling expenses, commissions and whatever. And you also get to deduct what we call the basis, or how much you paid for it, plus any capital improvements that you may have made. And the delta on that, now, if it is that you didn't rent it out for a certain period of time, there may be some depreciation recapture, and it gets a bit complicated that way. But essentially, that delta between what you paid for it and the sales proceeds that'll be the taxable gain, at least from a US perspective.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.